In today's lesson, we'll be looking at one of the very important topic in accounting. It is called trading, profit or loss account. If you are going in for any accounting related exams, WAEC, NECO, JAM, or any external exam that is centered on accounting, you cannot do without this particular topic. The examiner will always want to find out your strength on this particular topic. So because of this, we'll take our time to look at what I call the objectives, what we guide the focus of our teaching, the things you are expected to know under this topic. Number one, at the end of the topic, you should be able to define trading, profit or loss account, and you should be able to identify trading, profit or loss account items, and you should be able to solve related problems. You should be able to define, identify the items, and then solve related problems. How do we know if we've been able to achieve our objective? Number one, our ability to define trading account and profit or loss account, our ability to identify the items, and our ability to solve related problems. Now, definition. We want to look at what this topic is all about. Looking at this topic, if you observe, the topic has trading, profit or loss account. That is to say that two accounts are combined together in a single book. The first one is called trading and the second one is called profit or loss account. So let's look at what trading account is all about. Trading account is an account prepared to ascertain gross profit or loss for the period. We prepare trading account to find out if we are making progress in our trade. Every trader has an aim, and the aim is to make progress. That progress in accounting is called a profit. And if it is not a progress, it is called a loss. So the essence of preparing a trading account is to ascertain what we call gross profit. And then we also look at the difference between net sales and cost of goods sold. When we talk about net sales and cost of goods sold, we are looking at what will give us the direction to the gross profit. In other words, how do we ascertain the gross profit? What do we call gross profit in this case? Gross profit is simply the difference between your net sales and your cost of goods sold. Net sales is simply your sales minus return inwards. Return inwards, by the time we look at the images, the items, we are going to take time to explain each of these items. But for the sake of definition, you should understand that one, trading account is an account that is prepared to ascertain gross profit or loss. And then this gross profit looks at the difference between net sales and cost of goods sold for the period. And the last thing you should understand under the definition is that the left side of the account is the debit side, while the right side of the account is the credit side. We will not forget our fundamental principle, the double entry principle of accounting, that divide every account into two equal halves, the right hand side and the left hand side. And in this case, the left hand side is the debit side, while the right hand side is the credit side. Now, let's quickly go through the items of a trading account. Number one, what we call opening stock. The opening stock is simply the stock at the beginning of the period. You are operating a provision shop. Those goods you have in your shop at the beginning of the year is what we call the opening stock. And then the next one is what we call purchase. Purchase is simply procurement. Probably the number of goods you have in your stock in your shop is not enough. There is need to increase the number of goods you have. So the process involved in going to the market to buy more or to procure more is what we call purchase. And then the next one is carriage inwards. Carriage inwards has to do with the cost, those extra costs incurred in the process of bringing the goods from the destination of your supplier to the destination of your business. You know, sometimes students will ask you, what is the difference between carriage inwards and transportation? There is a slight difference between carriage inwards and transportation. Transportation is the totality of what you incur in buying the goods from your supplier. Why carriage inwards has to do with those costs in between the transportation process, those costs you incur. Example, loading fees. Example, uploading fees. You go to maybe area market to buy this product. When you get there, there are some persons that will help you to load them. The money you pay them is part of your carriage inwards. And then taking it to the destination of your business, the money you pay people that will help you to upload them, they are also part of carriage inwards. So when you have to add that to your cost of purchase. The next one is what we call return outwards or purchase return. Assuming you bought 3 cartons of Indomie and then getting to the destination of your business, you discover that 1 carton of the Indomie is not up to the standard of Indomie you are supposed to buy. You need to return it back to your supplier. So that 1 carton that is returned back to your supplier is what we call return outwards. So if initially you bought 3 cartons and you are returning 1, by extension you'll be left with just 2. So that one that is returned back to your supplier is called return outwards or purchase return. Then the last one, the next one is closing stock. Closing stock is simply the stock at the end of the accounting period. Please underline the word accounting period, because this period, it varies with organization. There are some organizations that will tell you that their accounting period run from January to November. Some will tell you from February to February next year, depending on the policy of a company. But at the end of that accounting period, the goods you have in stock that you are not able to sell is what we call closing stock. And then the next one is cost of goods available for sales. Cost of goods available for sales is just the relationship between your opening stock and your purchase. You started the business with 5 cartons of Indomie, you've gone to the market to buy 10 more cartons to make it 15. That 15 cartons is what we call the cost of goods available for sales. The cost of that 5 cartons that were available at the beginning and the cost of what you have bought, bring them together, give you the cost of goods available for sales. And then cost of goods sold. Cost of goods sold, in another parlance, we call it cost price. The cost price of goods that is actually sold out. You know, you cannot sell your product at the value or the cost with which you bought the item. So if, assuming you bought one carton of Indomie, 10,000 naira, and then you want to sell it, let me assume you want to sell it 15,000. That 1 carton of Indomie that is sold out at the rate of 15,000, that 10,000 you bought the Indomie is the cost, while the selling price is the 15. So we usually look at cost price, cost of goods sold, in the light of the real cost of the item. And then the next one is sales. Sales is simply the value of goods that is sold out. And then the next one is return inwards. When we were explaining return outwards, we said that we are returning what we have bought to our supplier. In this case, in return inwards, our customers are the one returning the goods back to us. Because what you do to Peter, Paul will do to you. In accounting, we give to receive, and then we receive to give. As you are buying, you buy to sell, and you sell to buy. So when you buy, and then there is time for sale, you sell out, your customer may also return part of the goods to you. So when your customer return it back to you, it is called return inwards. And then the very last thing is gross profit. This is now the last item you should know on trading account, gross profit. And gross profit, like we have said earlier, is the difference between your net sales and your cost of goods sold. Now, we've been able to define that. Let us now look at what profit or loss account is all about. I said earlier that is two accounts combined together in one single book. The first one is trading account, and the second one is profit or loss account. Now, looking at it, we have defined what trading account is. We've looked at the items. Now, we want to look at what profit or loss account is. This is defined as an account prepared to ascertain net profit or loss for the period. Now, ask me a simple question. In trading account, we have a profit called gross profit. But in profit or loss account, we have what we call net profit. Sir, what is the difference between gross profit and net profit? This is very interesting question. I want to take just less than 1 minute to answer that. Gross profit is simply profit before expenses. What do I mean? The difference between your net sales and your cost of goods sold give you your gross profit. But net profit is your profit after you have deducted the expenses incurred in the business. So, if you want to determine your net profit, you must have all your expenses arranged, or you must compile all your expenses. And then the difference between your gross profit and your net profit and your expenses give you your net profit. And then the second thing you should understand under the definition of profit or loss account is that income or gain is credited while all the expenses are what? Debited. Remember from the beginning, we said that the left-hand side is the debit side and then the right-hand side is the what? Credit side. That means that your income or gain must be on the right side of the account, and then your expenses must be on the debit side. And the last thing is that the difference between the credit side and the debit side is the net profit or net loss if the debit side is greater than the credit side. We don't wish any businessman to have the debit side higher than the credit side, because the debit side is the side for expenses. Once the debit side is higher or greater than the credit side, there is a problem. The business will begin to fold gradually, and before you know, it will be liquidated. So we don't wish any businessman or woman to have this experience. However, for the sake of this lesson, I want to emphasize that if you prepare this account and then you calculate your expenses, which is meant to be on the debit side, the left-hand side, and is higher than what you have on the right-hand side, which is the credit side, then you are making a loss. It is called net loss. Now, having said that, let's just take a good look at the items of the profit or loss account. Number one, expenses. Expenses, like I said before, they are costs incurred in the day-to-day running of the business. Some of those expenses, they include wages and salaries, transportation costs, carriage outwards, discount allowed, bad debt, etc., etc. Expenses in this case is very, very ambiguous. Why? Because it varies with organization. An organization that is into manufacturing has what we call a set of expenses. Organization that are into service provision has their unique expenses. So don't limit your understanding to what is being discussed in this lesson. When it comes to expenses varies with organization. But for the sake of this lesson, we are looking at wages and salary. We know that every organization pays salaries. We also know that every organization, they are involved in transportation. We also know that carriage, sometimes this is related to manufacturing account, manufacturing company, where they have to pay certain costs, or they have to transport certain materials to the destination of their customers. And then discount is something that every average businessman or woman will experience. And then bad debt is something that every business will experience. As far as you are selling on credit, there are possibilities that some of your debtors may not pay or may not have what it takes to pay their debt, and then that becomes a bad debt. So the expenses we have here is a summary of what every organization should experience, but it's not limited to what is being discussed in this lesson. And then the second thing you need to know is the income or gain. This income or gain, it could be cash that is received, or it could be cash that is earned but not received, and received but not earned. You can earn cash without receiving them, or you can receive cash without earning them. What am I saying? If I give you discount, if you come to a shop and you are giving discount, that discount that you are giving, you received this discount, but you didn't earn the discount. Now, if somebody give you commission, you are a sales agent and you're giving a target, and the target is that you are able to sell certain level of goods within the period, you are going to be given this commission. That commission that is received, it is earned. Sometimes they may not give it to you cash. Sometimes it may wait for you maybe at the end of the period. So you can receive cash without earning, and you can earn without receiving. And then bank interest. Bank interest is simply the returns you have on your deposits. And then the last but not the least is reduction in provision for bad debt. Every organization will set out an amount of money to cover up a debt you are not sure of recovering. Some debtors are actually very, very inconsiderate. They will come as if they want to die, and then by the time you give out the item to them on credit, they will not come to your shop again. So by the time they stay for a very long time, prudency as a principle in accounting provides that, or recommends that, you should make adequate provisions before profit is actually discussed or forecast. So to recover those debts sometimes will not be easy. So what you need to do is just to set an amount of money aside to recover these debts. It is called provision for bad debt. So when two different periods are compared, previous period and current period, if the provision for last period is higher than the provision for this period, then there is reduction. If it is lower, then there is increase. Increase is an expense, while reduction is an income. All right, having said all of that, let's look at something I call very important, or the fundamental of profit or loss account. It is the heading. This is where students usually find it very difficult. Some students will be in a hurry to prepare the account without adequate attention to what we call the heading of the account. The heading of the account must contain three things. Number one, it must contain the name of the account. Number two, it must contain the owner of the account. Number three, it must contain the period under which the account is prepared. So for trading profit or loss account here, you see, it should be trading, profit or loss account for the year ended. For the year ended. In this particular title, it is not open in the name of any person, because this is just an illustration. By the time we go to our exam guide to begin to solve questions, related questions, you will see that if you are preparing an account at all, then we must include the name of the owner of the account. But please take note, it must read in the name of the account, the period under consideration, and then the owner of the account. Now, having said this, we will look at the format. But this format we are going to look at, we will take some questions, related questions from our exam guide. By the time we look at the questions, it will further explain or illustrate how the trading profit or loss account looks like. All right, when you click on the exam guide, you have these options that will be displayed. You have the subjects, you have the various subjects. Our subject of interest is account. That is why account is already clicked. And then when you go to the year, you see all the years. If you observe there, random. I actually choose random because I really want all the questions that are related to what I am teaching to be grouped together. Meanwhile, if you have an interest in a particular year, you can decide to choose any year of your interest. It could be 2021, 2020, 2019. And then once you do that, you can now click on get started, and then the questions you need will just pop up. All right, let's look at the questions we have here. The first one we are going to consider now that relates to what we are doing here, the lesson for today is carriage inward expense. They say carriage inward expenses of a business is treated in dash. We have said that carriage inwards has to do with those costs that you incur in the process of bringing the product from the destination of your supplier to the destination of your business. And I have said that is one of the trading account items. So the answer there is C. And then it said carriage inwards is shown on, this is more like the first question, carriage inwards is shown on the dash. Where is carriage inwards shown? It is carriage inwards, we always see it on the first one, say credit side of the trading account, credit side of the profit or loss account, debit side of the profit or loss account, debit side of the what? Trading account. Carriage inwards is posted to dash, balance sheet, profit or loss, appropriation account, and trading account. It's always trading account. All right, let's look at this. You like cash, stock. Okay, this is not related. All right, they said closing stock was overstated. The effect is that when they say closing stock is overstated, it means that closing stock has been overcasted. That is closing stock that is meant to be 30,000. Let's assume your closing stock was meant to be 30,000. When they say it's overstated, let's assume the accountant mistakenly take it to be 40,000. So we have 10,000 naira difference. So what they are saying, they are asking, if it is overstated, what effect will it have on the account? The effect it will have is that if your cost of goods available for sales is 20,000, assuming, or let's take it to be 100,000. This is your cost of goods available for sales. And then your initial closing stock was 30,000. If you subtract this from this, if you subtract 30,000 from 100,000, you will have what? 70,000. This is when it is 30,000. But because they overstated it, now it's going to be 40. If you change this to be 40, that means your gross profit here is now going to be what? 60. So when closing stock is overstated, then gross profit will be what? Understated. So gross profit will be what? Understated. Where are we? Closing stock is what? The effect is that amount of goods available was understated, gross profit overstated, cost of goods sold, amount of sales, gross profit will have been overstated. Because if, okay, gross profit should be understated. That will have been the right answer. Gross profit overstated, cost of goods sold overstated, amount of sales return was understated, amount of goods available was understated. The right thing would have been that gross profit is understated, because the higher the gross profit, okay, the higher the gross profit, this is cost of goods sold. This is cost of goods sold. This is cost of goods sold, not gross profit. So let's take it again. I am saying that, let's start from the beginning again. We say closing stock was overstated. The effect is that now the original value, we have said that gross profit is equal to what? Net sales minus cost of goods sold, minus cost of goods sold. Now, we said cost of goods sold is equals to what? Cost of goods sold is cost of goods available for sales minus closing stock. This is where our emphasis lies. Now, if you have, assuming you have cost of goods sold to be equals to, let's assume it's 100,000. And then they said your closing stock is supposed to be 30,000. Normally, this will give you 70,000 as your cost of goods sold. This is supposed to be a cost of goods sold, but it was overstated. Let's assume it was overstated to 40,000, to 40. So because it was this thing was overstated to 40,000. If you subtract this from this, you are going to have 60. Again, 70 you are supposed to. So this is an understated figure. So because this figure is less than the original figure, this figure has been understated. So in that case, your cost of goods sold is understated. That is the right answer. So number one says your amount of goods available for sale was understated. Gross profit overstated. Cost of goods sold overstated. Amount of sales return was understated. Now, if your cost of goods sold is understated, that means your gross profit is overstated. If your cost of goods sold is understated, that means your gross profit is overstated. So the answer is B. Gross profit was overstated. As far as the difference between this and this will give you gross profit. This one is understated. As far as this one is understated, here will be overstated. So that's that. Let's look at the second to the last question. We have, they say sales was 12,500. Total expenses was 2,500 and net profit is 10% of sales. What is the gross profit? Very simple. Let's write it out. Let's just write it out. Your sales is equal to 12,500, and then your total expenses is what? 2,500, and they say your net profit is equal to what? 10% of what? Sales, which is 12,500. So the question is gross profit. Now, gross profit is equal to what? Let's do it like this. Net profit is equal to what? Gross profit minus what? Total expenses. Your net profit is gross profit minus total expenses. So let's put in the figures. Your net profit is 10% of this. That's 10% of this times 12,500 all over 1. 0 we cancel 0. This we cancel this. You'll be left with 10 times 125, which is equal to what? 1250. So your net profit is what? 1250. So then for gross profit, this is what we are looking for. Your total expenses is what? Total expenses is what? 2,500. So let's rewrite the formula again. Net profit is going to give you 1250 is equals to gross profit minus what? 2,500. This one you just collect like terms. If this 2,500 crosses the equality sign, it will become positive. So you have 1,250 plus what? 2,500. It will give you your gross profit. Let's add. Let's do the addition. We have 1,250 and then we have 2,500. 2,500. You have 0, 5. We have 7. We have 3. 3,750. So this will give you 3,750. That will give you a gross profit. So if you check the question, you have the options that has that is option B. So that is the answer. Let's take the last question before we end the session. They said, which of the following is charged to trading account? Number 1, discount allowed, carriage outwards, salaries, discount, carriage inwards. The answer is D, carriage inwards. I think that is where we are going to end the lesson.